hit its low in March 2009. By early 2013, it had fully recovered, about 4 years from the bottom. The investor who panic sold near that low and waited until things felt safe again, they missed most of that recovery before they ever got back in. Same crash, same world, completely different outcome. And the gap had nothing to do with the economy. It had to do with one decision. That's what this video is actually about. Most people believe that recessions are dangerous because the market goes down. But in reality, recessions are dangerous because of what you do while the market is going down. The drop is temporary almost every single time. What turns a temporary drop into a permanent loss is the investor hitting sell at exactly the wrong moment. So this video isn't going to teach you how to predict the next recession. Nobody can do that reliably. Instead, I'm going to show you what the data actually says happens during recessions, and the biggest mistakes investors make when they panic. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice.
You got a billionaire first. Subscribe Dark House Finance, I will tell you.
What is actually a recession? A recession is a significant decline in economic activity that spreads across the economy and lasts more than a few months. Many economists define a recession as 2 consecutive quarters of declining GDP. However, in the US, the official call is made by a group called the National Bureau of Economic Research, the NBER. They look at things like employment, income, industrial production, and spending, not just one number like GDP. And here's the part almost nobody mentions. The NBER doesn't announce a recession when it starts. They announce it months later, after they've seen enough data to be sure. Which means by the time you hear the word recession on the news, the economy has usually already been in one for a while. So when a recession comes in, how bad and how long are we actually talking about? Going back to the 1850s, the US has had 34 recessions. The long-run average length is around 17 months. However, that number is actually skewed by old and ugly recessions from over a century ago. Back before modern tools like deposit insurance and active central bank policy existed. Since World War II, the picture changes a lot. The average recession has lasted around 10 to 11 months. Some have been brutal and long, like 2007 to 2009, which dragged on for 18 months. Others have been almost absurdly short. The 2020 pandemic recession was officially over in just 2 months. Basically, recessions are a normal and repeating part of how economies function. You will live through several more of these, and every single time, it will feel like the one that's different. Which brings us to the first mistake, the recency bias. Every recession feels uniquely terrifying, even though the pattern repeats almost identically each time. We give enormous weight to whatever crisis is happening right now, and almost no weight to how similar crises played out historically. In 2020, people were convinced this time was different. It's a global pandemic. The whole economy is physically shut down. In 2008, this time was different. It's the banks. The entire financial system is broken. In 2000, this time was different. The internet bubble just proved tech stocks were a fraud. Every time the story changes, the underlying pattern doesn't. Here's the part that surprises almost everyone the first time they see it. Some of the stock market's best single days in history have happened during recessions, often within days or even the same week as some of the worst days. Take March 2020. 2 of the 10 worst trading days of the S&P 500 happened that month. And 2 of the 11 best days also happened that same month. Which means the moment that feels most terrifying is statistically close to some of the best days you could have stayed in for. Extreme volatility is driven by extreme uncertainty. When uncertainty is that high, prices swing hard in both directions. Panic selling causes the crashes, and any piece of credible good news, a policy response, or a rate cut, can cause an equally violent rally. The market doesn't wait for the crisis to be fully resolved. It reacts the moment the outlook improves even slightly, often while the headlines are still terrible. The second mistake is waiting for good news. Most investors don't try to sell at the absolute bottom. They try to do something that sounds much more reasonable. Wait until things calm down, then get back in once it's safer. Here's the problem with that plan. In many cases, The data confirming recovery comes after the recovery has already started. Remember what I said earlier about the NBER only declaring a recession has started months after the fact? Same exact problem here. If you're waiting for good news, you are by design waiting until after the best days have already happened. In mid-March 2020, markets are in free fall. The S&P drops something like 30% in a few weeks. Every headline is some version of worst crash since 2008. Lockdowns are spreading globally. Nobody knows how bad this is going to get, or how long it will last. What actually happened next? The market bottomed out around March 23rd, and then started one of the fastest recoveries in modern history, while the headlines were still overwhelmingly negative, while unemployment was still climbing, and while there was no end in sight. The people who waited for the news to feel better waited well past the point where most of the recovery had already happened. Confusing the economy with the market. The market is forward-looking. It's constantly pricing in what investors expect to happen months from now. Economic data, like unemployment numbers and GDP reports, is backward-looking. It tells you what already happened. So, when the news says unemployment just hit a new high and that the economy is officially in trouble, that's old information. The market has often already priced in that pain and, in many cases, already started pricing in the recovery weeks or months before that headline even runs. Bad economic news and a bad time to invest are not the same thing. So pull all of this together. Across past recessions, the investors who came out ahead weren't the ones who correctly called the bottom. Almost nobody does that, including professionals with research teams and decades of experience. The investors who came out ahead were the ones who had already decided in advance what they were going to do, and then just followed that plan mechanically when the panic hit, instead of improvising in the moment based on how scared they felt. So how do you actually apply this? Decide these things now, before a market crash comes. What happens to your regular contributions if the market drops hard? Are there any extra contributions? Decide that today, not during the panic. What's your actual emergency fund threshold? How many months of expenses? Decide that today. If you rebalance your portfolio, what's the specific trigger that tells you to do it? A percentage? A date? Something concrete? None of these decisions require you to predict anything. They just require you to decide once while you're thinking clearly, instead of deciding repeatedly while you're scared. And that's all for today. If you found this video helpful, don't forget to like, subscribe, and give your feedback below in the comments.
Subscribe me because more money making tips command high, I will tell you.